There's a guy named Marcus, 34 years old, software engineer in Columbus, Ohio, makes $115,000 a year. Last spring, he bought a $620,000 house because the bank approved him for it. So he figured he was fine. He's not fine. His mortgage eats $4,200 a month. His car payment is $480. His student loans are another $310. By the third week of every month, Marcus is eating rice and beans and quietly hoping nothing breaks. Then there's Diane. Same city, same year, same market. She makes $88,000 doing project management for a logistics firm. She bought a $260,000 house. Her friends told her she was settling. She didn't care. She has a fully stocked emergency fund, maxes her 401k, and took a 10-day trip to Portugal last summer without looking at her bank balance once. Both of these people bought homes in the same housing market. One of them owns their house, the other one is owned by it. The difference between them is a rule most buyers never bother to learn before they walk into an open house. If you're someone who's been pre-approved for a mortgage and feels vaguely uneasy about the number, subscribe and like this video. It will help more than you think. Here's what most people get wrong about buying a home. They treat lender approval as permission. If the bank says yes to $620,000, then $620,000 must be the answer. That's not how it works. Lenders are not your financial planner. They're in the business of originating loans. Their approval tells you what you can borrow, not what you can survive. The debt-to-income ratio lenders use routinely approves buyers at 43% or more of gross income going toward housing, but gross income is not take-home pay. It's not what you live on. It's not what absorbs a $12,000 HVAC failure or a job layoff or a medical bill that insurance covered 60% of. The real enemy here isn't the bank. It's the emotion of the moment. The house that smells like fresh paint, the yard you can already picture your dog running through, the pressure of inventory is tight. You need to move fast. That feeling will justify almost any number. The 30/30/3 rule exists to be louder than that feeling. Think of it like a speed limit on a mountain road. Nobody sets a 35 miles per hour sign to insult your driving ability. They set it because the consequences of being wrong at 60 miles per hour are unforgiving and the road looks straight until it suddenly isn't. The rule has 3 parts, and each one is doing a specific job. The first 30 means your total monthly housing costs. Mortgage principal and interest, property taxes, homeowners insurance, and PMI, if applicable, should not exceed 30% of your gross monthly income. That's the benchmark the U.S. Department of Housing and Urban Development has used for decades to define what affordable actually means. Gross income, not net. Which means if you bring home $7,500 a month before taxes on a $90,000 salary, your housing number is $2,250 or less. Not $2,800 because rates are lower than they were. Not $2,600 because you're pretty disciplined. $2,250. The second 30 means you should have at least 30% of the home's purchase price saved in cash or near cash assets before you close, not just the down payment, the full 30%. So on a $300,000 home, that's $90,000 in liquid savings. Why? Because 20% covers the down payment and gets you out of private mortgage insurance. The remaining 10%, call it $30,000, is your buffer. That's closing costs, moving expenses, and the furnace that dies 6 months after you move in, plus the cash cushion that lets you sleep at night when your hours get cut. This is where most people fall short. The national median home price has risen roughly 50% since 2020, while median incomes rose only about 29% over the same period. The gap between those two numbers is the saving shortfall that derails first-time buyers. They scrape together a 5% down payment, burn through their savings at closing, and then one unexpected expense away from credit card debt. Having 30% saved isn't being overly conservative. It's the margin of error that separates homeowners from people who just have mortgages. The third part is the simplest to explain and the hardest to accept. Your home's purchase price should not exceed 3 times your gross annual household income. If your household earns $100,000, that's a $300,000 home. If you earn $120,000, that's $360,000, no more. And here's where Marcus, from the opening, done went wrong. His $115,000 salary times 3 is $345,000. He bought at $620,000, nearly double the limit. That's not a small overage. That's a completely different financial life than the one he actually has. Now, Diane, she earns $88,000 3 times. That is $264,000. She bought at $260,000, right inside the line. Her mortgage at current rates on a 30-year fixed comes to just over $1,700 a month, about 23% of her gross income. She's inside all 3 guardrails. I know what a lot of people watching this are thinking. 3 times income in 2026? In what market? The national median home price is hovering around $380,000. The median household income is roughly $80,000. That's a ratio of 4.75. And in markets like Los Angeles and San Francisco, prices are 10 to 12 times income. The rule applied rigidly excludes a lot of people in a lot of cities. But here's the honest way to think about it. The 3 times rule wasn't arbitrary. It was calibrated around payment sustainability. I get the idea that at 3 times income with a reasonable interest rate, ours, the monthly payment, naturally falls within the 30% threshold. In high-cost markets, the rule adapts. Apply the 3 times multiplier to what you're actually financing, not the purchase price. If you sell a previous home and bring $150,000 in equity to a $500,000 purchase, you're financing $350,000. 3 times $88,000 is $264,000. Still a stretch, but the discipline of the framework still applies. The question is always, does the monthly payment fit inside 30% of gross income? If it doesn't, the math is telling you something. Here's where it gets uncomfortable. Lenders in 2026 will routinely approve buyers at 5 times, 6 times, even 7 times income depending on credit scores and market conditions. The bank telling you yes is not the same as the math telling you yes. They are 2 completely different conversations. And the psychological trap is this. Once you've been approved, once you've toured the house, once you've imagined your life there, every number starts to feel negotiable. You start calculating how you'll make it work. Maybe you cut the vacation. Maybe you pick up freelance work. Maybe rates drop in 2 years, and you refinance. That's the trap. That's just 1 more year syndrome, but applied to a 30-year commitment. The financial stress of overspending on a home doesn't show up on day 1. It accumulates. It shows up 2 years in when you haven't contributed to your 401k. It shows up when a job loss goes from stressful to catastrophic because you have no margin. Marcus isn't foreclosing. He's just quietly suffocating. Home ownership is supposed to be wealth building. When you buy more house than you can sustainably carry, it inverts. The house stops being an asset and starts being a trap. So what do you actually do with this? The first thing is to run your numbers through all 3 parts of the rule before you set a search price range, not after. Most people start with what they want then look for justification. Run the rule first. Take your gross monthly income, multiply by 0.30, and that's your maximum monthly housing cost, including taxes and insurance. Take your gross annual income, multiply by 3, and that's your maximum purchase price. Then check your savings. You need 30% of that price in liquid assets before you're ready to close. The second thing is to be honest about which of the 3 you're violating and by how much. Maybe your city makes 3 times genuinely difficult. Fine. But if you're following the 30% monthly payment rule and have a strong savings cushion, you're applying the spirit of the framework even if the purchase price is at 4 times. What you cannot do is blow through all 3 simultaneously and convince yourself it's fine because the market is special right now. The third thing is the hardest. If the numbers say you're not ready, believe them. I've been studying real estate for years, and the buyers I've watched struggle are almost never the ones who waited too long. They're the ones who moved too fast with too thin a margin. Diane waited 2 extra years to save her 30% buffer. She doesn't regret a single month of it. Marcus and Diane bought homes in the same city, in the same year, with similar lives. The difference between them wasn't income. It wasn't luck. It was one decision. Whether to let the bank set the ceiling or to set it themselves. The 30-33 rule is not glamorous. It will not get you into the house you're emotionally attached to right now. But it's the difference between owning a home and being owned by one. Between building wealth quietly and spending the next decade wondering where all the money went. The rule existed before the 2008 crisis. The people who followed it came out the other side. The people who ignored it because rates were low, because everyone else was doing it, because the bank said yes. Most of them have stories they don't tell at dinner parties. Drop a comment with your number. What's your 3 times ceiling? I'm curious where people actually land. And if you found this useful, a like or subscribe helps more people find it before they sign anything.